Hey, good morning and welcome to the Money and Finance for Expats podcast from Fiduciary Wealth Management. It's morning here anyway. Hello to you, whatever time it is in the world. And talking of the world, let's have a look at that global picture of finance with Fiduciary Wealth Management. Paul Correa, good morning to you, Paul. How are you?
Good morning, Carl. I'm very well, and you?
I'm pretty good. I'm pretty good. Keen to find out what's going on in the world of money and finance today, especially for expats. You, of course, specialize in helping people move to the Iberian Peninsula, especially those UK people who've been having an interesting Brexit post-Brexit week, haven't they?
Yeah, yeah.
Has that news coming through had any ripples heading towards Gibraltar?
Well, firstly, I can't believe we're in March because
Yes,
it's
that's true.
it's you know it's flown by so quickly,
Yeah.
that is just unbelievable that we are now, heading for the spring, 3 weeks
Yes.
away. So good
Yeah.
news.
Well, not
Um,
only March, Paul, 2023 as well. How did that
oh,
happen?
Christ, I thought it was only yesterday when I was a teenager, but anyway,
Yes.
I'm now close to retirement. No,
All right.
not quite, not
No,
quite.
not yet, Paul. Not yet.
Yeah, I think it's looking
Helping
like
others, helping others with that step, right?
exactly helping others with retirement. I mean, mine is probably heading for when I'm 80. But anyway, we move on swiftly. Yeah, it's it seems that they've sorted out this um acrimony between the UK and the EU over Northern Ireland. I don't think it's completely fixed, but it's heading the right direction. And of course, at some point, the attention will have to turn to Gibraltar because, like Northern Ireland, we suffered the consequences of a hard Brexit,
Oh, yes,
ill-planned,
of course.
ill-advised, and illogical Brexit. It's been painful, and we wait to hear some good news regarding Northern Ireland, and then of course the political attention, needless to say, has to turn to the next overseas territory, which is Gibraltar. Yeah,
Well, that hadn't.
Northern Ireland is not quite an overseas territory,
Sure, sure. No, but I understand. I
but
mean, yes, of course, implications for Gibraltar. So Gibraltarians watching closely to see what's going to happen, right?
and British nationals that are relocating to Gibraltar. Yeah.
Yes, yeah, incredible. Okay, so very heady and interesting times, as we seem to say every week. We will take a look at the big financial picture, global financial picture, and we've got some graphs as ever for you to talk us through that situation. And our special focus this week will be the ups and downs of QNUPS, looking for the ups in QNUPS after we've had a look at the global picture. So, should we go straight to those graphs then, Paul?
Yeah, yeah. I mean, I'll start first with the some of the data of last week because we have our show on Wednesdays. Some of the data comes at the back end of the week, so
Uh-huh.
we don't have graphs. So we just give a roundup of previous data, market expectations, but we haven't got the actual data for the month. So we're now going backwards into back end of last week to see what happened. And the first
Incredible.
one is really sales of new single family homes in the US. I mean, the figure jumped to 7.2% month on month, the highest reading since, I think, with a few exceptions, March 2022, although I can see a very strong figure there in August. I mean, this could be a sign that the housing market in the US is starting to stabilize following very aggressive rate increases. Um, so the general pattern of you know falling sales of new homes has not materialized. I think it's showing much more resilience than we would have thought.
Mm.
Quite a fairly stable and still strong housing market.
And surprising. The emphasis there is on that being a bit of a surprise, and and it's not
Completely,
a dip we're looking at.
completely, very surprising. I have to admit, it
Right.
does surprise me that the U.S. economy is so resilient, notwithstanding the twin evils of fiscal and monetary tightening. Quite unbelievable, really, that um, it's unprecedented in modern history that we've had in 2022 such an aggressive monetary tightening, and yet The US economy seems as strong as ever. Job market is, I don't know, there's 50, 60-year low in terms of unemployment. So full employment, almost 3.4% of the workforce unemployed, and the yeah, and wage growth still happening. So yeah.
Who pushes to the front to take the credit for this, Paul?
No, I think it's just that there's a lot of liquidity in the market, which hasn't really been, how can I say, hasn't been drained out of the system. Remember that
Right.
during the lockdowns on COVID, the US central bank, as other central banks, they injected an enormous amount of money in
Okay.
the system.
Yeah.
That money produces um, produces inflation and stimulates the economy.
Yeah.
And whilst they've been very aggressive, sorry, my phone, whilst they've been very aggressive in rate, sorry, just give me a second. I just want to make sure this doesn't happen. Um,
Well, it gives us a sense of the busyness of your office, doesn't it? Certainly, people. The
exactly,
world of wealth
exactly.
management.
No, it's sorry. Where was I? I've lost my.
I was asking who takes the credit, because obviously Joe Biden,
No,
the Biden administration, was saying, "Yep, just as we suggest."
sorry. Yeah, no. What the point I was trying to make is that whilst they've increased the rates very aggressively, they haven't really done much to drain that liquidity from the system. I think
Okay.
they're doing really small amounts, and they may have done, I don't know, 3 to 500 billion of liquidity has been drained out of the system. But remember, they injected, I don't know, 5 trillion of new money into the system.
Mhm,
So whilst they've tightened the interest rates, there's still too much money chasing too few goods.
mhm.
And unless they address that issue, they're only addressing half of the equation, yeah, so to speak,
Mm,
interest rates, but also draining that liquidity. That's
okay.
what's missing, really.
All right.
And unless you drain that liquidity, there's going to be inflation in the system for a while longer. I would imagine,
So
logically.
with that graph, then could it be that that's a liquidity, that the cash that's lying around is being
No,
spent on houses then?
well, I mean, not only that. Remember that if the US has the lowest unemployment in, I don't know, 50, 60 years, and there's wage growth because there's a shortage of labor, um, people are quite well off. You know,
Mm,
the recession hasn't really hit the US economy, and now on the balance of, on the basis of the data that is coming in, one has to question whether there's going to be whether the recession is really imminent. I
mhm.
think it's being pushed back further in time, maybe
Yeah.
later in the year, who knows? And then if there's a recession, whether it's going to be a short, whether it's going to be a deep recession, or more likely on the information we have now, that it's going to be a V-shaped recovery and it's just going to be technically in recession for 2 quarters and then we pull out again.
Incredible.
As I said, the data is still way too strong to be able to say that it's going to be, a devastating recession. There's no evidence of that yet. That doesn't mean that things can't change, but the data that is coming through tends to suggest that the economy is very resilient in the US. And
Amazing.
I can go to um, the next data released last week, which is the University of Michigan consumer sentiment. It
Way up.
came it came in at 67 in February. That was the reading, as you can see, versus consensus of 66.4. So better than the market expected, and a much higher reading than January, which came in at 64.9. So the data is consistent with the PMI readings, the Purchasing Managers Index readings that I showed you last week, that
Mm,
the US economy is more resilient to tighter monetary conditions than any analyst had envisaged. And you can see the graph there. It probably bottomed sometime in March. Sorry, I can't see with the green.
Well,
Um,
let's take a tape off for a moment.
okay,
June of
it
last
seemed
of 2020.
exactly. It bottomed in June. The reading was 50, but look, it's bounced back stronger than for a long time. So
Yes.
again, second reading from last week suggesting, or second piece of data suggesting, yeah, the EU economy. So I mean, the question to ask really, Carl, is um, will it require more rate hikes to dampen demand and weaken the US economy? And even then, on the evidence, a recession, if it comes, will be a short one, as I've just said, more like a V-shaped recovery, and it'll happen further down the road. It's not going to happen here and now, because as the data comes in, it's rather than pointing to an imminent recession, it's quite the opposite, right, Carl? And
Mhm.
I think we've analyzed enough graphs to arrive at that conclusion that no, there's no evidence that we're entering a recession right now.
Incredible. Absolutely incredible. Despite most people's feeling in their water, their intuitive sense, this is counterintuitive, I think it's safe to say, isn't it?
Well, remember the data is, some of it is backward looking, some of it is forward looking, and you can't rely on one piece of data to arrive at a conclusion. Yeah,
Mhm.
there's all kinds of data coming in, some of which are conflicting, but I think we're starting to see a pattern. Yeah,
Yeah.
that
Okay.
the pattern is emerging, and the pattern is very clear.
Yes. Okay. On to the next then. And does this reflect the pattern you're speaking
Well,
of?
this is now we move on from the US to the EU, to the European zone, and the core price index, the inflation data came in marginally higher than expected at 5.3. The market was focusing inflation at 5.2. Not significant because it's a marginal increase, but again, seems to suggest that inflation is proving more sticky in Europe as well.
Mm.
So yeah, I think, yeah, European. I've said it before. I mean, the European market seems fairly strong. Inflation doesn't seem to have um, turned the corner. Still very sticky. You can see the graph; it's almost up an upward sloping curve, and no signs that inflation is receding.
There you
So
go.
yeah, higher
Okay.
interest rates, yeah, is the only logical conclusion.
All right. Keep those questions coming in. We have a question about gilts, which we'll come to during the podcast today. We love the questions when they come in, so do send them in to us. Ask them in the chat as well. A comment just in. If people have less spend due to hikes in energy bills, will that not cause a contraction in the coming months? Do you want to take that now, Paul?
No, it's a great question. I don't know who's asked that question. We don't
Facebook
see
user,
names.
FU for sure.
Okay. But, well, I mean, it's a very valid point. I mean, I think there's a cost of living crisis across the globe, particularly in developed markets, in advanced economies. We're being squeezed by higher prices, energy prices, higher food prices, um, and stealth taxes. But yes, normally what you tend to find when that happens is that there's less discretionary spend.
Right.
So there's less consumer spending, and then for economies like US and the UK and Europe, which are service-based economies, when the consumer has less money in his pocket to spend, then there's less money circulating in the economy, and it tends to be a drag on economic activity. But
Okay.
yeah, again, I have to answer in the affirmative. That statement is absolutely correct, but it still hasn't shown in the data.
Okay. Thank you for that. That's
But
Phil, actually.
it might,
Yeah.
but it all depends, you see, because it depends on your net income, right? I think it affects more those on lower income brackets than maybe higher middle classes, where they have a cushion there.
Hmm.
Maybe they save less and they have to sacrifice savings for spending.
Hmm.
and they have to make some decisions because things are tighter, no doubt. But if you have sufficient income to cover your expenses and to save money, rather than reduce your spending, you might decide to reduce your saving to maintain your standard of living. So
Great
very good
question.
question.
It is a
Great
good
question.
question, and that came in from Phil. And you would expect, wouldn't you, in a just society, that the great profits being made by those energy companies, arguably, would find some benefit in the system through taxation. I don't know if that's actually happening though.
If you're expecting a fair world, I think you're going to die, and it's never going to happen, Carl.
Am I being a bit naive there, Paul?
Yeah. You know, I think it's yeah. I think we all hope that it's a decent that politicians are decent and do the right thing and you know that there's a equitable distribution of wealth
Yeah,
and in times of crisis those at the lower end of the income spectrum are given financial support to cope with difficult but you know reality is it doesn't always happen, yeah.
quite.
So
Okay.
and you're right, they're making a lot of money,
Yeah.
whether that money you know they're private companies
It
driven
might
by
it,
profit.
it might not be finding its way back into the system then, is what you're saying.
Exactly.
All right, okay. Here's the roller coaster ride again then. This one not looking so favorable. What can you tell us about this one?
Well, this one came in on Monday. It's the durable goods orders, and durable goods orders measure the change in the total value of new orders for long lasting manufacturing goods, including transportation items. So this is a reflection of the manufacturing sector and orders for goods in the US. A higher reading is normally positive for the dollar, whilst the negative reading tends to weigh heavily on the dollar. And the reason for that is that we're talking about exports and imports, and yeah, it has a bearing on the currency. The previous month's data came in at 5.6% plus, which was a huge surprise for the market. If you look for the whole year, it's been up or down almost zero, yeah. But
Mhm.
it came in very strongly, almost 6%. Um, and the forecast for this month was 4%. And then it came, sorry, let me tell you again. The previous month was very, very strong, surprised the market because it came in at plus 5.6%, which is a one-off, an outlier based on the graph for the whole year because it's been almost flat for the whole year. The market was expecting a decline of 4% for for the month of February, and it came in at minus 4.5%. So it what it does what it shows is that the or what it signals is that the manufacturing sector is weaker and than expected, and this is consistent with something I've mentioned in previous podcasts,
Mhm.
and that there's evidence of disinflation in different sectors of the US economy, but not all of them. And in the durable goods sector, is clearly one that I've mentioned in the past. It is the one sector where you can see some signs of disinflation.
Right.
So, yeah, I mean, this one seems to buckle the trend in the sense that it's a negative reading. Yeah.
Mhm. Okay. And finally then, we have this graph here.
And that is this is the consumer confidence index, and it measures the level of consumer confidence in economic activity.
Yeah.
It's a significant piece of data because it's a leading indicator, means it's forward looking and provides a pretty accurate prediction of future consumer spending, which is a key driver in the US economy. We go back to Phil. He said about consumer spending, right?
Yeah.
And the importance of, if there's a cost of living crisis, then there's a squeeze on the consumer spend, yeah, which is right. So this is a piece of economic data that pretty much addresses Phil's issue. Well,
Right.
the January data came in at 107.10. Sorry, the January data came in at 107.10, and the market was forecasting Feb's data to come in at 108.50. Um,
So from that, what consumer confidence is actually down then?
but the actual data came in at 102.90,
Right.
signaling that the consumer and the consumer's optimism about the US economy is waning.
Right.
So basically, a higher reading would have provided evidence that the jobs market is very robust and wage growth will continue to fuel the US economy and push back any notion of an imminent recession. But actually, the data that has come in, again, conflicting, creates confusion, shows that the data is considerably weaker than anyone expected. So the consumer is not that positive um, about yeah about the about economic activity in the US. And
Okay.
this is a really important piece of data. It's forward looking. Consumers are saying, we are very uncomfortable with the US economy. Our ability to spend is being curtailed by higher interest rates and higher food prices, higher energy prices. We're not that confident about the future.
Hmm.
So yeah, interesting that Phil should raise the issue, because
Yeah.
this one
Thanks,
is
Phil.
is is the one that addresses that key issue. See what we're saying here, Carl? Like in previous weeks, this conflicting data coming in, some
Mm.
pointing to resilience, some pointing to weakness, and yeah, and whilst some of the data that's coming in now is showing that the US economy is strong, there's evidence that there's disinflation within the goods sector. That's actually positive because it brings down inflation. But less positive is the fact that the consumer is not too confident about future prospects.
Okay. I'm looking at. Thank you for that. Thank you for the graphs. Before we move on to QNUPS, maybe let's talk about anything else that's caught
The
your eye
I
in
think
the world.
there isn't there one more piece of data to cover, or
I
no?
think we've got the five graphs there. I had to share with you.
Okay. Sorry. There's one more which comes out on Friday.
Oh, okay.
But there's no graph. That is the U.S. Institute of Supply Managers non-manufacturing of new orders.
Right.
This report is an indicator of the overall economic conditions for the non-manufacturing sector. A reading above 50 predicts or indicates that the non-manufacturing sector is generally expanding, and if the reading is below 50, then it suggests that that is contracting. Last month, the data came in very strongly at 60.4, so well above the 50 index, yeah, compared to December's number of 45.2. Can you see the how illogical this is? You see small changes, but in December the data came in at 45.2. So that is in contraction. So the non-manufacturing sector is contracting. And then in January, the reading is, not marginally higher, but at 60. So it's expanding. And we are to see what February tells us about the non-manufacturing sector and in what direction it's heading. Crazy.
So we'll report back on that next Wednesday. What do you? I'm looking
Absolutely.
at some of the headlines from the finance world. I'm seeing Goldman Sachs Moles deal options after consumer flop. Royal Bank of Canada's quarterly profit falls. British lawmakers ramp up pressure on banks over savings rates and executive pay. And Credit Suisse personal and business banking boss hold to leave. Lots of movement in the banking world. I guess you keep an eye on the banks to see what's going on there. It seems a little bit jittery in the banking world.
No, I think given the cost of living crisis, I think regulators, particularly in the US, are trying to drive better client outcomes.
For
So
what? So they're putting
that
pressure on the banks.
the on the banks and on financial services generally, it's
Yes.
all about, in time in these times where hard times for consumers, they are rolling out new legislation about protecting the consumer, and how do we secure better client outcomes. So
Right.
the regulator is on the side of the consumer and putting pressure on regulated firms to try and provide more value at less cost.
And thinking we can't have a repeat of 2008. That's in the back of their mind, isn't it? To better care of the consumer.
Well, I mean, better care of the consumer and making sure that the big banks exactly don't abuse their position of power at a
Yeah.
time when the consumer is very vulnerable.
Okay. So anything else before we move on to QNUPs? Anything else from the
No,
global
unless
update?
there's any questions. I think there was a question you were going to ask me about guilds,
Oh,
or
gilts. That's right. Yeah, let's deal with that now. Let me find that. Generally speaking, then, what's your feeling about gilts, and what are they actually for people who don't know what they are, including me, by the way?
that they issued by governments to fund their short, medium, and long-term liquidity requirements. So they are a a promise to pay back. Yeah.
Yeah.
So they
Okay.
issue guilds to fund their costs,
Right. So the
and yeah, and consumers can buy, and banks and whoever can buy those guilds. So whether it's institutional investors, yeah, corporates, or private individuals, you can buy guilds and they pay you a return. So it's the
yeah.
way that the government finances itself, and they have to issue bonds and or guilds, but they say they're called guilds because they're gilt edged. You have the confidence that they've been issued by a state, and the ability to repay back the initial capital is, you can't say guaranteed in this day and age, but you have that comfort that they are gilt edged. Yeah.
So they are
There's
the
a
same thing. Bonds and gilts are the same if they're
Well,
issued.
I mean, there's different types of bonds, yeah,
Oh,
but
okay.
they are effectively a promise to pay back with a coupon and a rate of interest.
Okay. So
So in general terms, yes, it's a kind of a yeah, of a bond, you could say that.
okay. The question is relating to expats. What do you think about expats buying UK gilts specifically? Can it be done? How is it done? And are they a good investment?
Well,
What would
we don't buy individual instruments,
you
so
say?
we can't answer that question. Is it the right time to buy gilts? I would say the answer to that question is probably no.
Okay.
And I base that on and I say this because UK interest rates continue to rise. The price of bonds and gilts work inversely to rising interest rates. So when interest rates rise, gilt prices come down, and when interest rates come down, gilt prices go up. Because the price of gilts are likely to fall further as the Bank of England continues to increase its interest rates, we have to wait for the right opportunity to buy those bonds and then secure, I don't know, for as long as possible, buy gilts paying the highest possible yield for the longest term possible, and then you secure a really, really good return.
Hmm.
So, in answer to your question, yes, I think maybe 6 to 12 months from now is the right time to buy some gilts to
Yeah.
secure a good rate of return for as long as you possibly can, because inevitably, at some point, the cycle will be reversed and we'll go back to rate cuts. So, interesting question.
Yeah. Thank you for that.
And yes, as a firm, we don't buy individual gilts,
What does that
but
mean though? So why don't you? What
because
is?
we don't buy individual instruments, we buy collectives or ETFs. So you
Okay.
can buy an ETF that tracks the 30-year US Treasury, or
Okay.
you
Right.
buy an ETF that tracks, I don't know, the 10-year UK gilt.
Right.
So we would buy those, and in
Yes.
fact, that's already part of our discussions, that we're waiting for the right timing to go into and have some exposure to government securities, be them US or UK or Europe. But the US is, in terms of the cycle, they are leading the way in terms of rate hikes. So the first ones that we would buy would be US Treasuries, and then the gilts, and then European bonds or whatever. So yeah, I mean, in the next 6 to 12 months might be the best time
Okay.
to have some exposure to gilts in one's portfolio.
Great. Okay. Well, thank you for that question. Really good about UK gilts there and whether expats should buy them. It doesn't really make a difference if you're an expat or not. It's just something you can buy. Anyone in the world can buy a UK gilt, can't they?
Yeah, they
If they
can.
wanted to.
There shouldn't be any impediment to buying the gilts. No.
Right. Okay. Excellent. All right. Well, let's move on to QNUPS, another acronym. If you could tell us what ETF stands for as well before we move on, and then move into QNUPS, that would be great.
Well, ETFs are exchange traded funds.
Okay.
Rather than buy a
Collect.
fund which is actively managed, an
Yeah.
ETF is normally a tracker. So
Right.
the underlying costs of buying an ETF is significantly less than buying a fund because a fund is actively managed, the ETF is passively managed. It tracks an index.
Right.
So rather than buy one gilt, you could buy, an ETF tracking, I know, 10-year gilts or 20-year gilts or whatever it is. And yeah, and you're not exposed to one single holding. Not that there's anything wrong with gilts, but if you're buying corporate bonds, you would rather buy an ETF tracker where you're
Right.
not exposed to a single issuer. Yeah,
Yeah.
that's the so it's lower cost and better risk diversification than buying the individual instrument.
Okay, I see that as part of my role here is to ask what the abbreviations and acronyms mean, because it's a world you work in all day, so you use the shorthand, don't you? So
Absolutely.
a bit more unpacking then on QNUPS, please. What does that what does that stand for?
Oh Christ, yeah. QNUPS. QNUPS is a qualifying non-UK pension scheme.
Okay,
It's an offshore unapproved arrangement which satisfies the definition of a pension scheme as set out by Section 150 of the UK Finance Act 2004.
mhm,
The fact it is unapproved does not mean that it is not recognized by HMRC. All it means is that it does not qualify for tax relief on any pension contributions that an individual makes, like an approved UK pension scheme would, yeah, like a SIP or a personal pension, where you have some tax relief on contributions up to a certain amount. That's why it's unapproved, but there's nothing untoward. It's perfectly legitimate. And QNUPS was born out of changes to the UK inheritance tax legislation and regulations, which came into force in February 2010,
right.
which allowed for individuals to put non-pension assets into liquid assets into a QNUPS arrangement, and it provides certain benefits which we can cover in a minute. That's really the essence of it.
Okay, all right. So there you go. That's what a QNUP is. And why do people need to know about this?
About what? About the
Well, the opportunity here, although the ups and the downs, I've put it of the QNUP scheme. Who does this apply to, and
well,
what's the benefit?
well, good question. I mean, this applies to individuals who have either left the UK for sunnier climes, let's say
Mhm.
Spain, Gibraltar, Portugal, for instance, because those are key markets, or those who intend to leave within 12 months. So it's no different to QROPS.
Right,
If you've left or you intend to leave within 12 months, then you can legitimately transfer or you can legitimately establish a QNAPS on the basis that you'll become a non-UK tax resident within 12 months.
right.
And it is and there's certain advantages which I will cover. What I find particularly disconcerting is to see regulated entities, local or otherwise, no names mentioned, claiming on their websites and literature that UK tax residents who wish to contribute more than those permitted under the annual allowance in the UK of £40,000 into a pension scheme may opt to use a QNUPS. in addition to the UK pensions to house the additional contributions. So, because you're limited by tax relief to 40,000 a year, you are a UK tax resident, you use up your 40,000 allowance in the UK to top up your UK SIP, and then any excess, you just open a QNUPS and you stick it in. I mean, that's the most stupid thing I've ever heard. I mean,
Right.
I've seen it on the website. I've seen it on the brochure. I think it is concerning that any regulated entity should be promoting QNUPs on that basis. Is
Wow.
completely
Okay.
wrong.
Yeah.
And the other thing they I've seen is that they say that high net worth UK residents who find that their UK pensions are approaching the UK lifetime allowance limit, which is currently 1,073,100, um, and basically it means if the totality of your pensions grow in excess of the lifetime allowance limit, then anything in excess of that, when you crystallize the benefit, you pay HMRC a tax, on a transfer when you crystallize that benefit,
Hmm.
over and above that threshold of 1,073,000. So basically, what this regulated firm is saying is that rather than be restricted by the lifetime allowance limit, um, if an individual feels that their pensions will not generate sufficient pension income in retirement to maintain their lifestyle, there's no problem. All they need to do is set up a QNUPS, which can complement the UK pensions and boost their overall retirement income. But you know what? They can do that in the UK. They don't have to be. They can be UK tax resident and just have a QROPS, a SIP, and a QNUPS alongside it, right? And it's clear here. It says high net worth UK tax residents.
Hmm.
You know, it's in the acronym qualifying non-UK pension scheme. I mean, for someone who's working in a regulated environment, I mean the giveaway is non-UK pension scheme, right?
Okay. Yes.
I mean, how frightening is that? That they are promoting to UK tax residents QNUPs when it has been designed specifically so they would be in breach of HMRC, and they'll end up being, the member of the scheme. The client would end up
Oh,
facing HMRC fines and
not the person who
liabilities.
gave them that advice.
Not the person giving advice for giving them, um, completely negligent advice.
Wow.
Unbelievable.
Okay. All right.
I can tell you that is incorrect, and this kind of advice should never be provided by a regulated entity wherever they are based. Yeah,
What do you
but
think the
this is
outcome will be of that? Will it sort of blow over and not get noticed, or do you think there is going to be some trouble in the pipeline with this?
no, unless there's a tip off to the regulator, nothing happens. Yeah,
Right.
and unfortunately, I hope, I hope that they haven't sold QNAPs to anyone on this basis,
Okay.
because the individuals will have a problem.
Right.
That I can tell you now.
All right. Thank you for that caveat. That may be very helpful to people tuned in who are interested in QNUPs. Tell us more.
So, yeah, the qualifying rules. So, it is only suitable, I'll repeat it again, for non UK tax residents and individuals who intend to leave within a 12-month window because they want to establish their tax residency in Spain or Portugal, Gibraltar, wherever that may be. You need to establish the scheme and draw down pensions before the age of 75. Um, Simply because, if you set up a QNAPS at age 74 and don't draw any income, you know, what kind of retirement planning is that? You know, at that late, at that stage of your life, yeah, you should
Mm.
do it much earlier, so it would be perceived as being a kind of a inheritance tax fudge.
Okay.
So really, has to be done before age 75. The sooner the better, and you have to draw benefits by age 75. Um, Let me tell you, QNUPS is not designed to accept UK pension transfers. It must be funded from non-pension assets. That's why we have the other acronym, which is called QROPS,
Europe's, yeah.
qualifying recognized overseas pension schemes, which
Hmm.
are funded from UK pension transfers, and its sister QNUPS has to be funded from non-pension assets. So, how much tax is payable on the pension income? I think that would be a very good question. This depends where you're tax resident in the Iberian Peninsula. And Carl, I mean, every country will have its own specific rules. I'm going to limit my response to the Iberian Peninsula because that's our key market. Yeah.
Yep, yep.
So if you set up a QNUPS and you draw down pension income in Gibraltar, you'll pay a flat rate of tax of 2.5%. Very
Okay.
simple, straightforward, 2.5. If you set it up in Portugal under the non-habitual regime, even though there's a headline rate of 10%, if it is structured properly through the use of annuities, you can limit the tax to 1.5% during your 10 years of non-habitual residence.
Okay.
In year 11, your tax rate will be based on, it'll be structured as an annuity again, but it will be based on your marginal rate of tax. But you would still, this is the interesting thing, even after the 10 years of non-habitual residency have passed by, in year 11 onwards, the tax payable through the use of annuities would be between 2.5 and 7.5%. So it's incredibly tax efficient. In Spain, the effective tax rate is somewhere between 2 and 6%, depending on how the pension is structured, on the amount that you draw down, because it's based on marginal rates, and the progressive rates of tax which apply in the autonomous region in which the individual is tax resident. Because Spain, whether you love it or love the country or hate it, the reality is it's quite complex, and every autonomous region has the power to set up its own taxes.
Yep.
So yeah, 2.5% in Gibraltar, um, minimum 1.5 in Portugal, could be more after year 11 under non-habitual residence, and in Spain you pay 2 to 6% based on the factors that I've just mentioned. So extremely tax effective. Um, Everyone keeps asking the same: how much can I contribute? Well, in theory, there is no limit to how much one can contribute because no tax relief is provided by HMRC, and but any post tax contributions, in other words, um, any contributions you make into a QNUPS in later life after you've been taxed from your UK earnings or whatever, has to be reasonable and has to be commensurate with your overall wealth, with your earnings, with your age, and with your future income requirements. So what you can't do is just to stick all your wealth into a QNAPs. If the funding and if the money that you put into the QNAPs is deemed disproportionately large, then it might be captured by UK income tax anti-avoidance provisions. And it would then be seen, as I mentioned earlier, Carl, as a fudge to reduce your UK inheritance tax liability. Because one of the great things about QNAPs that no one mentions is besides um, paying very little tax on drawdowns, it removes the assets that you stick into the QNAPs from your UK estate for UK inheritance tax purposes. But there's some guidelines as to how much you can put in. If you're worth 3 million and you stick 2.5 million, and then you've got no liability to UK inheritance tax, and you do it at age 70, guess what? HMRC, once you pass away, are going to say, you know what? This was a tax dodge as opposed to a legitimate bona fide pension scheme. So
Hmm.
there's some guidance and rules concerning what you can put in, and it's based around age, overall wealth, how much you draw, and so on. And this is where we guide the individuals to make sure that it's done professionally and correctly
Correctly,
to
yeah.
avoid ever being attacked by HMRC you know, once you passed away.
Yeah, that's
Uh,
the problem, isn't it, with entering into these things in haste and with the encouragement of some professionals. You have to take a long term and steady view, right?
exactly. I mean, care must be taken.
Yes.
Point number one. And it's always advisable that the individual receives suitable advice. And then, thirdly, in some instances, it might even be appropriate to get an actuarial report. So we've got firms that will write a report. It'll cost a bit, but not too much. And it gives you the comfort that you've taken the advice to make sure haven't overfunded the QNUPs.
Okay. All right. So a bit of
So
due diligence.
a bit of due diligence, and there's a process to follow, and you have to
Yeah.
do it correctly. But the benefits are great, Carl, and the assets will grow within the structure free of capital gains tax, whether it's Spain, Portugal, or Gibraltar. So it rolls over free of CGT, capital gains tax,
Yeah.
whilst it's inside the structure. So that is very tax efficient if you move to Spain or Portugal. There's no CGT in Gibraltar, but there is a CGT in Spain and Portugal for investments. So I think Portugal is 28%, and then Spain works on a progressive basis, but it's just as onerous as in Portugal. Um, you've got so there's the capital gains tax benefits, zero capital gains. The income tax payable is in low single digits, as I've mentioned, 1.5 in Portugal for the first 10 years potentially, 2.5 in Gibraltar, and between 2 and 6% in Spain. And then, in most instances, not all, you escape local succession taxes in Spain and Portugal. There's no inheritance tax in Gibraltar, but there is in Spain and Portugal, and you avoid it completely, provided, of course, the beneficiaries do not reside in the country of residence. So, in other words, in Spain, if there's a British couple living in Costa del Sol and the member of the scheme passes away, the wife inherits the scheme, continues to draw down the pension tax efficiently, and then she passes away. If the children are back in the mother country in the UK, and they are the beneficiaries of the pension fund,
Mhm.
then they will inherit it free of Spanish succession tax.
Okay. All right.
And then, of course, and the biggie that we are not allowed to push very hard, but it's true,
Mhm.
the contribution you make into the QNUPS is removed from your UK estate for UK inter, which is
Okay.
incredible. Because
Yes.
some years back, the politicians were looking at tightening that loop, but they decided that they should keep it because it's never been really abused. So it's still
Okay.
available.
Well, that's good to know. Excellent stuff. The sort of information you find out here on the Money and Finance for Expats podcast with
There's
Fiduciary Wealth
always
Management.
there's always a downfall, Carl. So I have to
Go on.
mention this.
All right.
The downside is that you do not have access to all your capital as you please. It
Right.
is a pension scheme.
Yeah.
It's a pension arrangement that is designed to provide you with a pension income for life. Um, so if accessibility to capital is a key consideration, it might not work. Or alternatively, you can it could work nicely alongside a Spanish or Portuguese bond. So you have the benefits of both worlds. One gives you full accessibility to your capital, and the other one, the QNUPS, maximizes tax benefits.
Right.
This depends on the individual, but advice is always individually tailored, impartial, and holistic, and it depends on the individual client. No client is ever the same.
Yep.
Um,
Okay. Well, that's what you can rely on with FWM. And to make further contact or to get more information, go to the website fiduciarywealth.gi is the suffix .gi, and reach out and have your questions answered. If your interest has been piqued by QNUP's discussion this morning, or if you just want to chat more generally about wealth management, you can do that via fiduciarywealth.gi. Is that everything on QNUPs for this week?
That is everything. I just wanted to give everyone a flavor of the benefits, of how it works, who's allowed to invest in a QNUPS,
Mhm.
what are the drawbacks, how much tax you pay, how to limit, succession tax in Iberia, how to avoid UK inheritance tax or reduce that liability. I think it's probably a pension arrangement that flies below the radar and not everyone uses because people have to get their head around it, and a Spanish bond or a Portuguese bond is simpler, but
Yes.
it's not always the solution. Yeah.
Fair
So
enough. Well, a lot's in the
so
name, isn't it? And perception, I think. A Portuguese or Spanish bond definitely sounds a lot sexier than QNUPs, doesn't it?
mm, mm, absolutely.
Yeah,
It's
but
and it's more widely known. Yeah. Yeah, the Spanish bond, everyone knows. So there's an air of familiarity
yes,
with the Spanish or Portuguese bond. The QNUPS is like, God, how does this work? And people get more edgy, but actually it's a great vehicle for tax and retirement planning.
there you are, a big fan, Paul Correa of Fiduciary Wealth Management. But of course, as he said, in the right environment for the right person, it's all about holistic and individually tailored wealth management with FWM. Anything else then before we conclude today's episode?
No, I'm just surprised that we don't get so many questions fired at us during the show. We seem to get them after.
Yes,
And, this is supposed to be an interactive session, where listeners can ask questions to the panel. Today, our panel is limited. Matt is not here, but we will endeavor to answer all your questions in the best way possible. And the idea is that it's not a one-way, street. That
yeah, definitely.
listeners should feel comfortable
Yeah, well,
asking questions, and we are more than happy to answer them if we can.
Well, thank you, Phil, for your question, and our Portuguese podcast listener who asked the question about gilts as well. I think part of the problem, Paul, is that they don't want to give away their secret billionaire status, but we won't make any assumptions about people, will we?
Zero. I mean, besides, Carl, this is about because we are passionate about giving back value to the British expat community, the Iberian Peninsula. We see it as a way of thanking them and showing our gratitude for the support we've had. We want to give them as much information as we can so they make the better choices and they can live their lives in retirement knowing that they can enjoy their lifestyle in retirement, making sure the advice is always best advice, and making sure that everyone is well informed and they're
Brilliant.
not duped into going in one direction in the interest of the advisory firm rather than the individual.
Which
And
can
that is our
happen.
mission, really.
Yes, indeed. And what a great invitation. So get in touch with fiduciarywealth.gi and you can speak to Paul and Matt, who you see on your screens every week. So, talking of which, yes, we'll be back again next Wednesday at 11 o'clock Portuguese time, which is, of course, midday for you, isn't it, Paul? Time for us siesta
It
nearly.
is.
All right.
Absolutely.
Okay.
As soon as the lights are out, Carl, siesta it is.
Okay. Thanks so much, Paul. Really enjoyed that. We'll see you again next week.
Thank you. Have a
All right.
lovely day.
Okay,
Take
bye for
care.
now, everybody. Thank
Thank
you. And
you.
keep those, and as Paul says, keep those questions coming in via YouTube and the Facebook pages, and while we're live on the screen here. Bye for now. See you next week.